Good evening, everyone. Welcome to Credit Conversations, a Q&A about all things credit. Now, I just wanted to let you guys know that my whole reasoning for this is I wanted to have a way to have folks talk live because, of course, many of you who've seen my YouTube videos, please go to that and you can look for Credit Renovators. And I have videos where I talk about all things credit, a lot of things beyond credit there to help answer your questions and do that. But I wanted to have something live where people can ask me questions in this way rather than one at a time on a phone call or just listen to me talk about this topic and that topic. I can address people's concerns in real time. So I've seen as I've been posting this is the third week and I haven't really been getting a lot of response from folks and to register to attend it. So I'm going to ask you this question. I wanted to clear up one thing and say, are you guys not registering, not clicking on the link, not realizing that there's a link there that I need you to click on, and that takes you to a page where I just need you to register for the webinar. And I just need to be able to do that so I can make sure I have enough slots on my Ring Central on the webinar for the number of people who plan to attend. So I'm asking that you do that. All you do, you click on the link, you fill out a page, name, phone number, email address, so I can let you guys, so you'll be able to get the link to attend the webinar live and you can ask your questions. There's no cost involved. And I just need to be able to have a head count for the webinar. The only way you'll be able to attend live is to click the link and register. So at some point in time, you know, the first few videos I'm going to repost just to let folks know what can anticipate. But at some point, the live webinars may only end up being posted sporadically. So I want you guys to get this information, and I want you guys to be able to. I want to be able to serve you live and give you that rather than just spout information and then you try to plug it in and see if it works. If you want to ask me specific questions about your credit or anything like that. Sorry, my phone's ringing. And I'm sorry about that. But yeah. I look forward to serving you in the future. I'm hoping I'm going to do this every Wednesday or once a week. If you guys tell me a different day, I'm going to do it until I get it through my head and nobody really wants it. But this is what I'm going to do. So this week, because I'm doing this basically live by myself, I generated some question and answers based on what I get the most of when I'm doing credit audits and when I'm doing credit conversations in front of live people in groups and one-on-one. So I broke them down into several categories. The first category is home and auto credit basics. First question, what is considered a poor credit score? Well, going by FICO or Vantage Score 300, which are very similar, a score below 600 is generally considered poor, and they have categories. They say poor, fair, good, and excellent. And the ranges vary, but it's pretty much the consensus is if you're below 600, that's considered a poor score. Next question. So to that, you say, well, why is 620 a significant score for home loans? In the mortgage space, we all know, if you've seen enough of it, FHA says they will lend as low as 580, which is true. However, there's a couple of things you have to consider. Number one, at a 580 score, well, at a score of 620 or less, you will have to put down more than the FHA minimum 3.5% down payment. At 580, they will go as low as 580, but you'll have to put 10% down on your purchase instead of the 3.5%. You need at least a 620 to go 3.5. Also, often most lenders have what we call overlays where they say, oh yeah, FHA will go to 580, but the portfolio loans that we sell at FHA, we don't want to sell anything less than that because we don't want the riskiest of risky loans, because obviously the lower the credit score, the riskier the loan is, even though they got to do. And then most people who are going FHA don't have the 10% that to put down. They're going to FHA because they need to go as low as 3.5. So keep in mind, 620 is sort of is a floor that you're most likely going to get a mortgage approval at. So 620 is important. Question 3, can I get an auto loan with a score under 620? An auto loan, not a mortgage. And yes, absolutely you can, but just keep in mind, the terms are going to be lousy the lower your score is. I mean, you're going to have a higher interest rate, which means you're probably going to have a higher payment as compared to someone with a better score and a lower rate and a better payment. Now, granted, our automobile lenders, dealers are excellent at cultivating a great number of lenders that will have a loan for just about any and everybody. However, it always comes at a cost. So keep in mind, the better your credit score, the better your credit overall, the better your financing is going to be on just about anything you borrow on. And keep in mind, I want to stop for a minute. We talk a lot about scores because we know scores, there's minimums. We talk about scores. We talk about scores for funding, for your fee and your rate and your terms and things like that. But remember, in the credit repair mindset, you don't want to focus on scores. You want to focus on the information on your credit report, because guess what? Your credit score is a byproduct of the information on your report. All your positive things help your score. All the negatives, the delinquencies, the lates, the collections, all of those negative things will push your score down. All the bad news brings you down. So people try to take an approach of fixing their credit. They say, what do I need to do to make my score go up? But they should be saying, what should I do to make my history, my credit report look better? Because when you focus on what's on the report and make it better, remove negative items, clear up things, resolve past debt that's still reporting negative, whatever it takes, whatever is appropriate to fix that, that's going to result in a higher score, not the other way around and say, well, I'm only going to focus on the things that'll make my score go up. Because essentially anything positive is going to make your score go up. Anything new and positive is going to make your score go up. Anything new and negative is going to make your score go down. And you remove negatives, it'll make your score go up. If you remove positives, it'll make your score go down. So keep in mind, the focus is on the information on the report. The score is a byproduct. So keep that in mind. So next question, how does my credit score affect loan interest rates? In other words, your terms. Obviously, lower credit scores, which means you got the lower credit scores are there because you got a bad information. That bad information tells new lenders that you don't necessarily are willing or able to manage your debts in the past, so why should they trust you with a new one? That's essentially what they're saying. That's why history is important, because they're judging you, they're judging us based on what we did in the past, they think we will do in the future if they were to give us this money. The score is a gatekeeper. So obviously, the lower your scores, the higher your interest rate is going to be, because most lenders price what we call price for risk. The riskier they think you are as a borrower, the more they're going to charge you in case you don't meet your obligations. They can at least get as much money as they can early before you falter. And again, you say, are they judging you? Absolutely. Is that right or wrong? I don't know, but they're judging you based on your past behavior. That's the real of credit. They're judging you on your past behavior. And so if you don't want people to judge you on your past behavior, then behave good. Or if you know people are going to judge you on your past behavior, I should say, then behave where you'll be judged well. If you don't, if you got bad history, if you can get it removed, then they don't have to never know. That's all part of the credit repair, credit restoration process, which includes credit repair. So that's a big reason why you can't outbuild your credit with new credit and ignore the old bad stuff, because people still gonna look at what you did before. It's like Girls Gone Wild. Once you the girl that was known with her boobs out on the Girls Gone Wild video, you can't, no matter what you do later, they're still gonna remember that you were that. It's sort of like that. Next question, are there alternatives if I can't qualify for a conventional mortgage? Absolutely. I talked about FHA, but in addition to FHA, you also have VA, which is for our veterans. Thank you for your service, for those of you watching. Then there's USDA, which I know we think about that. We think about farm and meat. It is for properties that are more rural, but not an actual farm, not an actual working farm. It's just that those are properties. They may be like our regular conventional homes. Any of you guys ever go out in the Amish country where the houses are quarter mile, half a mile apart. And so they don't meet necessarily meet the density requirements that Fannie, Freddie, FHA like to see when they're trying to figure out conformity, because in the rural areas, houses tend to be of all different styles. So it's hard to get comps that way. So USDA kind of fills in that gap. And then of course we got RD loans, which is total rural development. Those are different ones, and they have slightly different underwriting guidelines, for different things. But yes, you definitely have alternatives to conventional financing, conventional being Fannie Mae and Freddie Mac. And of course, bank loans, because there's banks that, they're known for, they say they don't sell their loans. They don't sell the service on their loans. That's what they say. And so they keep the loans in-house. Not too many of those anymore. So next section, improving your credit score. I'm trying, because I grouped these together. Yeah, okay. It says, this is straightforward. You're probably asking right now, what's the first step I should do to improve my credit score? Well, I tell people the very first thing you do is you need to obtain and review a 3-bureau credit report. Yes, I know you guys use Credit Karma. Yes, I know many of you use Credit Wise. Yes, I know many of you get a free Experian report through your bank or your credit card. That's all fine. But the important thing is that you receive a report that has TransUnion, Experian, Equifax on it. Now, the easiest way to do that and get a 3-bureau report, all 3 bureaus, one report, all your information, is annualcreditreport.com. Not freecreditreport.com, annualcreditreport.com. That is you getting the credit bureau directly from them, not through a scoring model, not through a third-party vendor or anything, but you're getting your TransUnion directly from them, your Experian directly from them, and your Equifax directly from them. It's a real simple process. You used to have to do them individually. Now you don't have to. You used to could only get your annual credit report once a year. Now you can get it updates more frequently. Now they've tried to make it more consumer friendly so that people can really monitor their credit. So that's a free way. Now I do recommend and offer and folks, my clients and of course the auditors, credit audits, the prospective clients, I said there are credit monitoring services that they can use. They're not required to, but I say this is a quick way to get a 3-bureau account. But I do tell them too, there's a subscription with that. There's a free trial if they want to just get a look. I'm sorry, it's not free. It's $6 to look at their credit score, but it's the full report. You can get it quickly, but annual credit report is great. But that's another way to do it, absolutely, and be able to look at that. They also offer tools to help you with your score that you might find helpful if you maintain the subscription. But most importantly, a few of them, they have a $1 million fraud and identity theft policy included with your subscription. So if you do have any problems and you end up costing you money, that you can get reimbursed from them through that. That's a good service in and of itself. kind of like LifeLock and some of those. They got dark web protection and those things. So that's just something to consider. But absolutely, you don't have to spend any money to get your credit report. You can go to annualcreditreport.com, get it for free, get it real time. You're not going to get any scores, but guess what? We don't care about scores yet. The purpose here is to get the report and see what's on there and see if there's anything wrong, what's negative, what do we need to do to make your report stronger, healthier, better. So after you do that, then the next thing you want to do is you want to go through and look at each account and make sure that the information is accurate. You want to start with your personal information, make sure the spelling of your name is correct. You should, if you have any name variations that are not your name, you should submit a letter, or actually you can go on the 3 bureaus and you can submit that, say you want to update your personal information, and you can tell them, no name variations of my name on my credit report except whatever the one you go by. Addresses. This is my current addresses. No other addresses are mine. This is my employer. No other addresses employer is mine but this one. And then they can have a current and a previous. They can have a current and a previous. There should be only one current, one previous, and it should be the same across all 3 bureaus. So those requests you have to do across all 3 bureaus. Now, those are not things, despite what you see on the internet, those are not things that are going to instantly boost your score. But by cleaning up all of that, it opens the pathway to when you do come across accounts that are not yours, they're usually associated to names that are not yours. So by removing those names, a lot of that mess can go away. But it's just a good practice to clean up your credit report, have everything 100% true and accurate, because that's the name of the game. Making sure, because the Fair Credit Reporting Act says nothing on your credit should be there if it's not 100% true and accurate. So let's start with the personal information. As you go through the credit report, you want to look at all your accounts. Do you recognize this creditor? Is the status of the account, the date that it opened, the current status, the pay history, the balance, the line of credit, your monthly payment, all of that stuff should be correct as far as you know based on your account statements, and that information should be the same on all 3 credit bureaus. If you see any discrepancies, make notes, because we're going to tackle those later, right? So then the next thing, you go through all of those, you do that. Now, obviously, anything that's not yours, you make a note, say this is not mine. Then the next thing you want to do after that is you want to ask them anything that's not yours, or that you want to recognize, or especially with the collections, you want to request a investigation and for them to validate and verify the accounts, the collections. So any of the negative items, you want to get them investigated, and you submit that to them. Now, there is a process, which I remind my clients often. When you dispute items, it takes time. It's got to go to them. We have to give them time under the Fair Credit Reporting Act. We got to give them 30 days from the time they receive our request, which is usually 7 to 10 days afterwards. I tell folks, you can do the online electronic request, but they tend to get bounced. I recommend that you print the letter and mail it to them. Certified would be even better, because that way they can't say they never got it, because they got to sign for it. And make sure your return address is on the letter and the envelope. But you send that to them, let them do their investigations to prove that those debts are yours, especially the collections, because you want to do that by requesting that they validate everything. And then once you receive that back, they're either going to say, yep, we validated everything, and here's our proof. And so they would provide you with the documentation they would have gotten. They would have contacted the creditor and say, okay, yep, you had an account. Here's your pay history that led to your delinquency. Here's where we bought it, and now we want to pay you. But they got to make sure that it's done correctly, because if they didn't buy that debt correctly, they didn't assign it correctly, or any of those things, that's an opportunity for you to get that taken off your credit report. Now, it doesn't mean the debt goes away, but it will be removed from your credit report. And that's a big distinction. So remember, there's a difference between having a debt removed from your credit report and having a debt eliminated. That's not the same thing, because they could still send you letters and say you owe us money. But if it's not legal for them to report it on your credit report, that's the thing. And for the purposes of this conversation, that's our priority, is to clean up the credit. And so there's a series. And I want to remind folks that this is a series of back and forth that happens. When you send those letters, they may respond and say, nope, everything is right. And you can say, well, where's my proof? And then they may send the proof the first time, but usually they don't. Some of them do. But then they go back and get the proof. But usually what happens is when you start asking for proof and they know they don't have it, they'll usually send you a letter saying, hey, we see that you're interested in this account. We want to settle this matter. You owe us $1,000. We're willing to settle this today for $179.62. Do you want to take it? And then if they do, you want to properly make sure that they agree in writing to remove that debt before you pay them. And then you'll have something in writing. So if they don't remove it after you pay it, you at least have a letter saying they allow it to be removed, and you can try to get it removed yourself, reaching out to the credit bureaus, which there's some back and forth that you have to go through to do that. But it's very much doable, and that's the way it's done. That's the way I do it to get collections removed from people's credit report. Just understand, it's a process. It can take some time. It's not instant, and it's certainly not always done the first time. So that's essentially what you're doing there. Now, we can expand on that more in individual basis, but I'm trying to keep it light and get through a lot of the Q&A things that people ask about outside of disputing. Next question. How important are on-time payments? Well, absolutely. They're crucial. As I mentioned before, payment history makes up 35 to 40% of our credit scores. So you definitely don't want lates. You don't want delinquencies, 30-day late, 60-day, 90-day. You certainly obviously don't want collections and charge-offs, which are the antithesis of on-time payments. But it's important that you pay on time. Now, there's many reasons why people struggle with on-time payments. The one that I see very often is when people, they have a car payment that's due early in the month at the same time as their mortgage or rent. So they essentially got their two biggest payments and usually some other bills all coming at the beginning of the month. And so I want to remind you guys that you most certainly, if you got that issue, you can contact your creditor, most likely the car lender. You can do it with either one, but most likely with the car lender. Contact them and tell them that, hey, I'd like to move my due date to a different part of the month because I'm having a budget conflict with my rent or mortgage. They'll be more than happy to do it because, number one, if moving your due date makes it more smoother for you to pay on time and they have to worry about it less and you have no delinquencies, they're more than happy to do it. And because they don't want you to be late. A lot of people think they want them to be late. They want that late fee. No, they don't really want the late fee. It's more important for them to have loans in their portfolio with A and B borrowers who have strong on time with a history. And so that's the value when a lender has loans on their books, your pay history makes that loan more or less valuable based on how good or bad it is. So when you got good online history, you're actually making your loan with them looks more valuable in their books if they ever decide to sell off some of their debt to other lenders to free up capital to do other things. So lenders don't just sell bad debt. They also sell good accounts too if they want to free up cash. So keep in mind, when you pay on time, they love you more, they treat you better, you're more valuable, and it's reflected in your pay history and your credit history and lastly, your credit report. So absolutely, on-time payments. Avoid late payments at all costs. Okay, next question. What is credit utilization and why does it matter so much? Well, lenders care about, and creditors and credit reporters, they care about credit utilization because prior to the 2008 bubble busting, you used to be rewarded for if you maxed out your credit card, but you paid it off every month. They said, oh, okay, this is a strong borrower. They got good cash flow. They're using their card, yet they're responsible enough to pay it off every month. This is the kind of borrower we like because this looks like the old days of American Express where you didn't carry the balance. You had an open 30-day account. So you use your card as much as you want, no spending limit. You use much as you want because you paid it off at the end of the month. And that's what the credit reporting and the credit scoring people were used to. Well, when the bubble busted in 2008, the large majority of borrowers who use their credit cards that way were high income borrowers in the financial section. And of course, we know people in the financial sector got laid off in large amounts when the stock market crashed. And so after the dust settled and the lenders looked back on it, they said, oh, the vast majority of people who went belly up were the folks who maxed out their cards and then couldn't pay them off. So they no longer considered that habit as being a good thing. Now they said we want to see conservative levels. So the credit utilization ratio was baked into the scoring model in 2012 when they did an update. So now you get dinged when your credit score is over, your credit utilization is over 30%. So what exactly is the utilization? Simply put, it's the balance that you carry divided by what your total credit limit is. For example, you got $1,000 credit card, 30% of that would be $300. So you don't want to carry a balance of more than $300, not only one month, but continuing on every month, where you're going to get dinged. You lose points because they say you're at high risk. At 30%, you're at high risk. They want to see you below 30, the lower the better. I always advise my clients try to stay at between 15 and 20%. If you need to use your card, manage it that way. But ultimately, what ends up happening is when you maintain low credit utilization over time, they're going to offer you a higher limit anyway. Because a lot of folks who have low limit cards say, "Oh man, my limit's only $300. If I only use 30%, that's $100. What can I do with $100? A tank of gas, half a tank of gas, or something, like that, or 2 tanks of gas rather." Something like that. But the idea is it benefits you because when you maintain credit utilization over long term, they will raise your credit scores your credit limits, because they want to see you use your card more. And if you're using your card less to maintain that 30% utilization or that lower utilization, they say, oh, well, maybe if we give John a higher credit limit, he'll use it a little bit more. And so we can get some more merchant fees, because remember, they make a lot of money on merchant fees when you swipe your card. So they want you to continue to swipe your card, but they don't want you to swipe too much, and they want you to pay it off and keep it down. They don't want you to carry too high a balance, things of that nature. So they will raise your limits. And so once you get some substantial limits, it's a lot easier to stay at 30, 20%, because now you got a nice chunky number. Obviously, if your credit limit is $5,000 instead of $1,000, you got $1,500 that you can use a month and stay under and be at 30. Obviously, if you don't want to carry a balance that high, you could stay at $1,000 and be at 20, 22% interest credit utilization, and everybody's happy. Each of your creditors looks at your other one. They say, okay, you're not in danger with any of the other guys. You're good with us. Your overall credit is good. And that's how you maintain a balance, a good credit rating, a good credit history, and then you get better scores and so on and so forth. So that's what makes credit utilization matter so much. Next question, should I close unused credit cards? Typically, I say no, 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 don't close anything. When you're trying to build your credit, improve your credit, fix your credit, don't close anything, but at least not necessarily. And I say that because, first of all, you want to look at that account and see where does it fall? Is it one of your oldest accounts? Is it one of your newest accounts? Is it one in the middle? And I say that because in addition to that 35% of your credit score going from payment history, there is another 20% that is from your credit age. And I mean, your credit history age. So the longer your credit history is over time, you get points for that. You get a higher score for that. And then they also look at the average age of your accounts. If that unused credit card is an older account that added to your average age, closing it could reduce your average age of open accounts, and it could negatively impact you. If it only affects your overall age, it won't affect the overall age unless it gets dropped off your credit, and closing it doesn't drop it off. But if it affects the age of open accounts and is significant, it could have a negative impact. So all things being equal, if you got an unused account, as long as it's not costing you any major money to keep it open, I would just say keep it open, use it sparingly so that if you still have a need for it, just to keep it active so that the creditor doesn't close it, the grantor doesn't close it and have an impact on your score. So all things being equal, I would say don't do it, like I said, unless there was some ridiculous annual fee or something that you say, I'm not paying for this anymore. Next question, how do new credit applications affect my score? Now, of course, each hard inquiry will lower your score a little bit. It's somewhere 3 to 5 points per inquiry. So that obviously multiple inquiries over a short amount of time can have a negative impact on your credit, except when you're shopping for a mortgage or shopping for a car, because those are big ticket purchases, and you shouldn't be penalized for doing your due diligence and shopping around when you're going to spend hundreds of thousands of dollars on a mortgage, tens of thousands of dollars on a car. And let's face it, if you shop at 5, 6 mortgage companies, you get 5, 6 approvals, but you're checking for rate. We know you're not going to buy 5 or 6 houses. If they submit you to 5 or 6 auto lenders, we know you're not going to buy 5 or 6 cars. But if you apply to credit cards, not revolving and non-secured credit cards, each and every application, each and every inquiry dings you separately, and they will impact you. Whereas with the mortgage and the automobile, all those inquiries within a 30-day period only count as one. So there is a distinction there. I know there's a lot of talk on social media, people about clearing inquiries. Inquiries really don't hurt you that much. I know a lot of people talk about disputing inquiries if they did not lead to an actual credit transaction. You can most certainly do that. But I say, I don't know how much work it's worth it to do that for 2 or 3 points when there's more other things that you could probably work on your credit that'll give you more traction and improve your credit profile overall than worried about a handful of inquiries. That's just my opinion, because I look to say, if you're going to do the work, let's work on things that matter, that have more value to them. And so a question, what is a secured credit card? I think most people know this, but I did add it in because it was there, because it does come up, secured versus unsecured, because there is some confusion about that. Secured card basically is if that you put up $300, $400, $500 on deposit, they give you credit limit matching your security deposit, and it's a way to establish credit. Typically what they do is when you establish yourself with them and you don't have any problems with any of your other creditors on it, because they will do a soft pull. They look and see how you're doing they know how you're doing with them. They see how you're doing with your other creditors. If you're all good, typically what they'll do is they may raise your credit limit above and beyond what your security deposit is. So they may, if you put $500 in after 6 months of good pay history, then they may raise you to $750, maybe even $1,000, let you establish that way, another 6 months, maybe a year. Then eventually what they'll do is refund you your security deposit back. And they say, well, you reestablish yourself. We love and trust you to be able to manage without a security net. We trust you now. And so then now you have an unsecured card, and usually any other cards you get in the future after that, they will all be unsecured. So, and then you can take that money and use it for something else. But that's basically, it's a way for them to help you reestablish credit and trust you by giving the security deposit. Another question, how does becoming an authorized user help? Well, put simply, that person who's allowing you as an authorized user, that positive history, assuming it's a positive history, you get to share that, and it's on your credit report. So if they got a long history, it adds to your credit history. If they got good pay history, which they should, or else you shouldn't be using it as an authorized account. Their good pay history becomes part of your history. They're good, if they got good credit utilization, that becomes part of your credit utilization. So you basically, becoming an authorized user, get to share in that person's positive pay history, positive action. And so it'll help you. Now, here's a question, and I'm not advocating it at all, but I do get this question all the time. What exactly is Experian Boost? Basically, Experian Boost is a free tool. Keep in mind, TransUnion and Equifax have similar programs, but it's just, Experian Boost is just the name that they gave to their self-reporting self-reporting account profiles, things like your utility bills, your rent, all of those things. You can have those because they don't normally report on credit, but you can request to have them pull those things and add it to your credit score like a regular account. And Experian just came up with a clever name for theirs. It's called Boost. Some of you may have seen the commercial with the purple cow and John Cena, and that's what it was all about. But it's by adding utility bills, mobile phone, all of those things to your credit report to help boost your score, assuming you got positive pay history, of course. Next question. Get this one. I know this one's probably going to make your antenna go up. How long do negative items stay on the credit report? Of course, everybody knows that answer is no. Most negative items information remains for 7 years. But here's the part that most people don't know. And I'm going to ask you, 7 years from when? I'm listening. But seriously, 7 years. Now, there's two different clocks going on here. There's a credit clock, there's a debt clock. Now, when you have open credit accounts and say you get a late payment, or say you get some sort of delinquent action on that account, and then that account closes, right? That negative item on that credit report is going to be there from 7 years from when that negative delinquency happened. It should not be on your credit longer than that. Now, do we see things on credit longer than that? Absolutely. But when you investigate them through the process I talked about earlier, and you determine that my delinquency, it's been 7 years since I first went delinquent, this shouldn't be on my credit anymore. And then you make that request to the creditor and or the credit bureaus, say, hey, this no longer meets Fair Credit Reporting Act guidelines. It's been more than 7 years since I went delinquent. Please take this off my credit. And you go through the steps, the back and forth, the different rounds of submitting, requesting it, see what they say. If they take it off, great. If they don't, you got to resubmit again. You got to ask them a second time with a stronger letter, more, firm words about that. And then after the third time, you can always go to the Consumer Finance Protection Bureau and file a complaint that they're reporting inaccurate information or outdated information. Now, on the debt side, you got the delinquency, and then they often sell that off to a credit bureau. And then you go through that process, credit bureau, credit collection agency, then you dispute it through that process. If they can prove that they have a right to collect on the debt, did they get an assignment and different things like that. And if they did it right, can they still collect? Maybe. If they didn't do it right, certainly get it removed. But even if they get it right and they do have the right to collect, they may not have the right to report it on your credit report. Like I mentioned earlier, it's a huge difference between what's on your report, what they can report, and what they can collect on. They may be able to collect on that account, but they certainly can't report on it if they don't have if they doesn't meet the Fair Credit Report guidelines. So, but 7 years from the last delinquency is the answer to that. So it's not 7 years from when you feel like it. So know your dates. It's important that you know your dates when you're disputing negative items based on the 7-year itch, as it will be. Next question. Can paying off collections improve my score? Yes, especially if the collection agency updates the status to paid. And that is the thing. So when you see people on the internet saying, don't pay collections, don't pay collections, don't pay collections follows with an unless, and you have to go through the investigation process of validation and verification to determine where exactly is the deal with any third-party collections. And then that's going to dictate what you do next in terms of whether or not you pay anything. So it's not no collections up front. I know there's a lot of people out there that sell credit repair as a service with the promise of making collections go away through the dispute process. And they tell you that without even knowing what it is. And I can say, be careful of those people. If they promise to remove a collection without even seeing what it's all about first, I would question everything they say after that. Not saying they're not, but I would certainly question it and ask them, how do they intend on making that happen? But the important thing is whether you pay or not, whether it's removed or not, you don't really, collection agents, you don't want them status updated to paid. I want them removed as if they never happened with third-party collection. Now, if it's a collection account with your original creditor and it was in collection status, you paid it, then you want the status update to paid or current. But when it's a third-party collection with a company you never heard of, never had any dealings with them, I say I work to get those jokers off, and I think you should too. You'll get a better, cleaner report, usually a higher increase in score, rather than saying that you had a collection and you made it better. That's still a negative. It's much better to get it removed. So next question, do medical debts impact my credit? Not too much anymore. Well, I can tell you like this. As of 2023, medical collections less than $500 should not be on your credit report at this point in time. Right? So that's for certain. So if you see any medical collections on your report less than $500 balance, they definitely shouldn't be on there and they can be easily removed. Now, here's the rub. A new guideline went into place in January that said that no medical collections of any size will be reported on credit. And the CFPB, the Consumer Finance Protection Bureau, mandated that rule go into effect on March 15th. However, if you guys have been watching the news with all the different changes to government agencies by Donald Trump and Elon Musk, the Consumer Finance Protection Bureau, which is the enforcement arm that for the Fair Credit Reporting Act, they've been in limbo. They've been shut down. We're back up. They've fired half their people. And so now it's unclear whether that provision for all medical bills is being enforced. It actually went into effect. So you may or may not have larger medical bills, but I recommend at this point in time, dispute them as though with the assumption that that new provision is in effect and is enforced, and get those medical collections off your credit report if they're not falling off by themselves already. But in 2025, we should not be seeing medical collections of any kind on your credit report. So here's a biggie. I get this one. What is the impact of debt settlement on my credit? I can tell you like this. I never tell people not to try to save any money. I understand, but I think of it like this. I tell people all the time, keep in mind the debts on your credit, assuming we've eliminated all the errors and all of that. The debts on your credit report are yours. Remember, you spent this money, you charged this up, you borrowed. So they are yours. Now, I say it's fine if they want to offer you a negotiated settlement for less than the full amount. I'm not saying don't take it. I'm not saying it's a bad idea. Just keep in mind, there are repercussions when you do that. Because remember, our goal is to clean up your credit, remove as many negative items as possible to make your credit report the strongest and healthiest it is. And as a byproduct of that, you're going to have better scores. Well, guess what? When you settle a debt for less than full amount, the chances of them allowing you to do that and still remove it from your credit report is very difficult on current accounts. It can still happen with third-party collections, but it becomes more difficult. So you're making a choice. Do I want to save the money or do I want to save my credit? Because typically you won't get both, because when you're requesting them to remove third-party collections from your credit report, most times they will remove it. But when you're trying to work on it, let's say you got that credit card that it went in delinquent, it went default, it went bankrupt. It went into collections and charge off. And now it's sitting on your credit report in charge off status. And then you reach out to them and you make payments to get rid of it. And then they say we'll take less than the full amount. They're still going to want to report it. They need to report the status from collection charge off to current satisfied or agreed, but they're going to want to leave a comment in that comment section that says account settled for less than full amount. That is still considered negative data, and it's going to have an impact on your score. So I think personally that when it comes to paying those things, pay the full amount, get the best outcome you can for your credit report, because you're going to save more money than that. You're going to save that money with better terms on your mortgage, on your car payment over the life of the loan, and that and everything else you borrow on. You're just going to be saving money down the line. So you're going to give up. And remember, it's not like you're paying what you already owed in the first place. Because had you paid it on time and in full, complete to begin with, you would have never had a collection. Sorry if I sound like I'm judging or preaching. That's just the fact. All right. And so the last section I'm going to go over is actually it's a couple more, but understanding credit nuances. This is credit stuff. Okay. Why do you have different scores from each bureau? It's because there are variations in the information between the two. Part of the credit restoration process is we want to make sure that the information is complete matching, because if the information is the same account, it should be the same on all three. Fair Credit Reporting Act says information must be 100% true and accurate. They can't all be 100% true and accurate if they don't even match each other. So there's a problem there. But the information is different. That's why the scores are different, more or less. Okay. What's the difference between FICO and Vantage scores? They are both different scoring models. FICO is famous. Everybody knows FICO. Vantage is somewhat famous. Vantage was actually created by the credit bureaus themselves because they wanted to offer people an alternative to FICO, because FICO is basically the 800-pound gorilla in the room, and to keep them from having a monopoly on credit scoring. But the slight difference is in that, like I said, payment history is the biggest one. FICO payment history is 35% of your FICO score. With Vantage, your pay history is 40% of your score. So people with Vantage scores tend to have slightly higher scores because they're getting more credit for the pay history. Subsequently, they tend to have lower scores because they're getting deemed worse for having bad pay history. Aside from that, there's some differences between the other ones, credit utilization, things like that. But there are basically two credit scoring models. Vantage has only one model, which is 3.0. FICO has several models. FICO 2 for mortgage lending, FICO 8 for general lending. FICO 9 has become the new one because it's been around long enough. They'll probably be retiring FICO 8 in the near future. It's just all a matter of which credit lenders like which one they like to pay for. Next question. How does the length of credit history affect my score? Like I mentioned earlier, the longer your credit history, the more positive that it influences your score. That's it in a nutshell. So if you drop accounts, you close accounts, be careful, make a note of their credit history and all that and how it could impact your score. Because sometimes people will have a negative account and it's one of their oldest accounts. And if they try to get, rather than dispute the information, they try to dispute the entire account and get it removed from their credit, and they lose on that history. And the impact to their score might be worse with that gone than it was when it was negative. But it might be easier that way to start a clean slate. You got to kind of look at it. Like I said, another one of those if-thens. Next question. Does income affect my score? Nope. Income is not factored into your score at all, though lenders will look at your income as part of the decision making in things like a mortgage, less so in auto lending circles. Usually they just want to know where you work. But in mortgage, you absolutely have to, income is part of the consideration. It's the three C's. It's credit, collateral, and capacity. Capacity is another name for income. Collateral is another name for the house and your assets. And then credit, of course, is your credit history and score, but not just the score. Because if you got large collections that are, that need to be addressed so they don't become liens on title, things of that nature, you may have to address those to get your mortgage approval. Not every collection on your credit report needs to be cleared for the sake of mortgage decision. Obviously, you want to clear them up to give you a better credit profile. But for mortgage lending, large collections are the ones that they're most worried about, and judgments and things like that. Can I improve my credit score quickly? Of course, I get this one all the time when people are paying me. How long is it going to take? How fast is it going to be? Now, score improvements on certain things you can see in 30 to 45 days. But that's not to say your report can be totally cleaned up in 45 days if you have significant collections and things. But you can start to see improvements the minute you start improving your report. And what that could be everything from your score is going to start to improve when you stop being late. Your score is going to improve when you start addressing your collections. Your score is going to improve quickly when you reduce your credit card balance and your utilization to start falling below that 30%. Those are the things you can do right away to improve your credit score, Johnny on the spot. Everything else is part of the process of getting things removed by request via the creditor and or the credit bureau. Preparing for major purchases, like a mortgage, like a car. Obviously, you want to have that minimum score of at least 620 for a mortgage, or at least 620 for anything. And then another question, how can I prepare for a mortgage application? Make sure your credit report is accurate, as clean and as strong as possible. Make sure you get your debts down, but hopefully don't do so much that you don't have any down payment money. Avoid new credit inquiries, especially right before that, because they're going to ask, because if they see a bunch of inquiries, they're going to say, did you open up any new credit cards from these inquiries that are not showing up on credit yet? And then that's more information you got to get documentation for. Since they can't see it, now they're going to ask for a statement. If they see inquiries for cars or anything like that, they're going to ask you, did you buy a card and it's not on credit yet? If it is, then they need to review that documentation. So usually it's simpler and easier to just not If you're thinking about buying a house, don't buy anything. Don't apply for anything else in the meantime. You can do that to a lesser degree with cars, but it's important that you keep it clean, keep it simple. That makes the underwriting process go that much smoother and a better chance of you getting an approval when the underwriter doesn't have to look at crazy exceptions and things of that nature. I'm an underwriter by profession, so I can tell you for sure. Question, should I get pre-approved for a loan? Absolutely. I believe that people should get pre-approved. Well, you have to get pre-approved for a mortgage nowadays. That's the standard practice. But I tell people too, I tell my clients and I tell everybody that listens, that will listen to me, that you should get pre-approved for your automobile loans too. I recommend that you start with your local credit union. If you don't have a relationship with one, you should get one, because credit unions, their whole purpose of being is to serve the membership. So you're more likely to get, assuming your credit is decent, you're more likely to get a better loan for your automobile from your credit union, even a mortgage possibly. You're more likely to get a better automobile loan rate approval from your credit bureau, from your credit union versus going to the dealer. Also, too, by being pre-approved, you take the credit approval process out of your car buying process. I'll talk more about that later, but basically it's better to know how much money you can borrow, which essentially means how much money you got to spend when you go looking for a car. So they can't tell you this car, you can get this car and that car. You say, no, I'm approved for $35,000. What y'all got for $35,000? And then you can select your car knowing how much money you got in your credit pocketbook. That's essentially what a pre-approval is. And that way you can level the playing field when you're negotiating for a vehicle. I've told many people that, and they've come out much better doing it that way. Next question. How does a cosigner affect my loan application? This one's a little complicated. It's simple for automobile, a little more complicated if you're trying to get a cosigner for a mortgage, a co-borrower. So let's talk about the car one first, because that's usually the frame of reference that people go by. When you're trying to buy a car, if your credit is not up to snuff and the car dealer really wants to sell you this car, they'll usually suggest that you get a cosigner. That cosigner being somebody whose credit is better than yours. And then it can depend, they may add that person on. And again, this happens when you don't get a pre-approval, like I just mentioned a moment ago. But if you decide to go to the dealer and finance there, and then they tell you your credit is an issue, they'll ask you, can your husband, wife, brother, sister, anybody, co-sign for you? Because if they can get another person on the hook, and if their credit is better, they'd much rather have two people on the hook for this loan than one. So typically when you get a co-signer, it doesn't take you off the hook unless yours is really bad and they say, we don't want you on this loan at all. And then you have to decide whether they'll let you be on title without being on the loan. That's the individual thing. But it's flexible in that regard. However, on the mortgage side, you're not allowed to do that. Well, you're allowed to do it, but here's the thing. You can't add a co-borrower to a mortgage application to help with credit, because the credit is always going to be determined by whoever is the lowest credit score of the borrowers. So it's the lowest middle score, actually, but that's another story. But basically, you can't add a borrower to a mortgage transaction for better credit. You can only add a borrower if you need more income or assets, but you can't bring us, because if you got bad credit and you bring in another borrower, you got to go off, because even if their score is better than yours, we still got to go by yours because yours is the lowest. If their score is lower than yours, then that certainly doesn't help. So keep in mind, co-signers, co-borrowers do not help for credit, do not apply in the mortgage world, only in other non-mortgage lending. Okay. And it was question is, what's the role of a credit counselor? Credit counselor is basically somebody like me, that can help you come up with a plan to manage your debt and help you clear up your credit items. And so basically, again, let's wipe away the past, let's manage the present, and then let's build for the future. That's what credit restoration is. So those are 30 questions I have here, most frequently asked questions about credit as I get them. But that's all I'm going to talk about tonight. I appreciate your patience. If you sat through this whole video, please, I would love it if you register for the live events, because I would much rather do this live and interact and have folks be able to, we have credit conversations. And so that we can all learn together and we can all build and improve together and move forward. So because better credit leads to a better life. So see you guys next week.